Introduction to British REIT. Real estate investment trusts, REITs, were introduced in the UK in 2007 and the appeal of the UK REIT continues to grow since then. Most of the UK largest property companies have converted to REITs. A real estate investment trust is a property investment company which, very broadly, simulates, from a tax perspective, direct investment in UK property, and so avoids the additional layer of taxes that can arise when investing through a corporate structure. It also enables exempt investors to benefit from their own tax status. Unlike lots of other property investments, it can be easily traded on the stock market exactly the same as any other share. Most REIT shares trade on major stock exchanges across the world, including the London Stock Exchange. You can find publicly traded REITs on the stock market, where individual investors can buy, sell and trade shares, and these transactions are usually regulated by the Financial Conduct Authority. There are over 50 REITs listed on the London Stock Exchange, collectively worth over 70 billion. However, they're not all alike. In exchange for operating within these relatively strict rules, and to encourage investment in UK real estate, REITs do not pay corporation or capital gains tax on their property investments. REITs is an attractive way for ordinary investors to invest in property. You have the possibility to invest a small amount, rather than the tens of thousands needed to buy a property outright. Investors can get their money back at any time. But be careful, as with any investment, you could back less than you originally put in. What is a REIT? Real estate investment trusts, REITs, are companies that rely on taxable income from owning, operating or subsidizing real estate projects. In order to qualify as a REIT, at least 75% of profits must come from indifferent property types of rental property, rental or mortgage interest, and 75% of the company's assets must be involved in the rental business. REITs must also pay out 90% of their rental income to investors. Therefore, the majority have diverse properties within their portfolio. Real estate properties fall into three categories: residential, commercial, industrial, hotels and resorts, rental properties, shopping centers, student housing, and many other property types. The advantages for income investors. Having to pay out 90% of rental income as dividends can make REITs an attractive option for investors looking for an income. The special tax arrangements also mean dividends are only assessed for tax once, when they reach investors. The recent announcement that the UK corporation tax rate is to increase from 19% to 25% from April 2023, has created a renewed buzz of interest in REITs. In particular, many investors could benefit from a 20% effective rate or less, depending upon whether they benefit from treaty rates or exemptions. Lots of REITs have long-term lease agreements with their tenants, which helps to make rental income and dividends relatively reliable, though of course there are no guarantees. Those who are able to impose regular rent reviews on occupiers should also enjoy steady income growth. Different types of REITs. In general, the two most common types of real estate investment trusts are equity REITs and mortgage REITs. However, there are a number of additional REIT sectors that fall into subcategories, which include the following: office REITs, skyscrapers, biotech firms, office parks, government buildings; industrial REITs, warehouses, distribution centers, e-commerce properties; retail REITs, shopping centers, power centers, grocery stores; infrastructure REITs, telecommunication towers, energy pipelines, wireless infrastructure; residential REITs, student housing, apartment complexes, family homes; healthcare REITs, hospitals, medical office buildings, doctors' offices, care homes. REIT returns to investors come in two parts: dividends, changes in net asset value, NAV, NAV represents the value of all the assets owned by the REIT. If the assets owned by the REIT, less any debt, are worth £1 million and there are 1 million shares in issue, the NAV per share is £1. If the value of the properties increases, either through market movements or development activity, the REIT's NAV will grow. REITs have to pay out most of their income to investors, so it is hard for them to save enough capital to reinvest in new properties from their own profits. So if companies are looking to expand, they have to sell new shares or take on debt. REIT debt is measured in relation to the NAV through loan-to-value ratio, LTV, which is the proportion of the property portfolio that is funded by borrowings. A higher ratio means more leverage. Property prices are cyclical and property values may change quickly. A REIT with a high level of debt can quickly find itself in trouble as LTV shoots up, especially when a downturn hits rental income, reducing its ability to service or repay debt. Different REITs can afford different levels of debt, depending on how reliable is the rental income. However, we tend to think that LTVs of more than 40% are comparatively high and should be avoided in normal times. How to pick the best UK REIT? It is possible to objectively rank UK REITs in a number of ways. Longevity. Historical total shareholder return. Running dividend yield. Annual management charge. Although each of these is only a factor, a single ranking is not an ideal way to choose a REIT. We suggest that you consider a blend of factors and continue your research in more detail after finishing this article. Other fundamental considerations could include: what types of property does the REIT specialize in? How diversified is the REIT? Is the REIT well managed? Investments rise and fall in value, so you could get back less than you invest. Income is variable and not guaranteed. The best UK REITs by longevity. I introduce a full list of REITs and their founding dates from multiple sources, and in order to help you to separate the ancient institutions from the modern upstarts. The best UK REITs by income yield. Dividend yield is an obvious way to analyze the REIT market to highlight some of the highest performing trusts. Investing for an 8% yield will always attract you to high-risk investments which are likely to be more volatile and possess more downside risk than lower-returning options. Remember, not simply invest your money in only the highest-yielding REITs available. I am introducing a list of the REITs, together with their dividend yields as of the time of writing. Best real estate investment trusts by market capitalization. Remember that the biggest does not always mean best. The larger a REIT, the more likely its shares are traded frequently and the bid-ask spread between the buy or sell price is lower, which translates to lower investment costs. I am introducing a list of the REITs, ranked by its market capitalization. Thank you for watching the video. If you watch all my lectures, you may be able to start investing in rental properties a little quicker. Please subscribe to my channel and press the bell to get alerts when a new video is posted. Please write your comments, questions, or concerns you would like to share.